I think the next paper is what explains geographic variation in corporate investment. Nishant, by now, I guess you know the rules. Tanika, you have the job of making sure that Nishant sticks with his time limit of 15 minutes, and Nishant gives you the same favor in return.
Sure. Thank you, Susan. Just want to check if you can hear me properly and my slides are visible.
Yes.
Perfect. Thank you so much. So thank you to the organizing committee for including this paper in the program. Today, I'll talk about what explains geographic variation in investment. This is joint work with Shohini Kundu, who is now at UCLA. So we want to motivate this paper by noting a fact which has been documented since a very long time, that investment seems to be geographically concentrated. So think about Steel City or the Silicon Valley, where investment seems to be geographically concentrated. I assume, or at least 2 years ago, we were all sitting in Hotel Sofitel, which was in BKC, which was itself an economic cluster. So while we know that these economic clusters exist, we still do not have a clarity on what results in the origination of these clusters, as to what are the fundamental forces which can help us understand the origins of these clusters. And this is super important in understanding geographic inequality. Why are certain areas which have all the investment, why are certain areas which do not have investment? Or more broadly put, why are certain areas richer than the others? And this is important in understanding so this is not only important to understand that why are certain areas richer than the others, but also from a policy perspective important, because it can tell us what can we do to basically address these geographic differences. So as I've already pointed out, the research objective that we have in this project is what explains geographic variation in investment. And this is in no way a new question. We have had conventional answers to this question. Majority of them rotate around the provision of Marshallian forces, which we think about as the availability and the cost of factors of production. We think about geography as being an important determinant we also think about firm characteristics or self-fulfilling expectations as alternative explanations, which can explain geographic variation in investment. In this paper, we're going to diverge with the extant literature, and we're going to argue or try to convince you that history can actually explain geographic concentration in investment. And we will also attempt at talking about what are the channels through which history can explain the geographic concentration of investment. So when we think about history, and my undergrads was in engineering, so we can always think about, yes, it's like so obvious to write down a model where you can show that the current state is dependent on the starting state of the project. However, in economics, it's very difficult to argue, and primarily because of the Krugman 1991 multiple equilibrium hypothesis. He says that it is very difficult to distinguish that the eventual equilibrium is a result of history or starting point, or is it a result of self-fulfilling expectations? And more importantly, empirically, there are a lot of confounding factors which can basically hamper our understanding of how history can explain geographic variation because of availability, because of geographic differences in the availability and cost of factors of production, or the actual differences in the geography itself. So in this paper, we attempt to answer this question using a historical setting from India. So in India, we had a colonial rule because of which certain areas fell under direct rule, which meant that the British removed the pre-existing sovereign and took a direct control of those areas, and indirect rule where they allowed the pre-existing sovereigns to rule in those areas. So this is going to be a setting in terms of historical differences in areas. And there has been prior work by Lakshmi Iyer's 2010 paper, which talks about how indirect ruled areas have high institutional quality. However, we will argue that that is not the primary mechanism through which can explain the geographic variation in investment. So just to summarize where I'm heading. So first, I will document the fact for you showing that investment is geographically concentrated. Specifically, I will show you that concentration is 20 percentage point higher relative to a frictionless benchmark. I will go over the details of the frictionless benchmark that we have in mind. Then we will show you that institutions or history can explain 13% of total geographic variation in investment. And going more micro, I will show you that on the intensive margin, projects are approximately 11% smaller in direct ruled areas relative to indirect ruled areas. And on the extensive margin, I will show you that projects are 25% less likely to be announced in direct ruled areas. In terms of mechanism, how does this manifest? I will argue that this differences in geographic investment primarily manifest that these differences primarily manifest through historical differences created because of differences in economic organization and state capacity. So giving an overview of the data. So first of all, what we do is we collect data on historical boundaries from Baden-Powell. So over here, you can see that, so over here, the areas marked in blue are the areas which were under indirect rule, whereas the areas marked in red were under direct rule. So you can see that these areas are not like concentrated in south, north, east, west, but they're actually all over the place. And in terms of our data, the primary data source that we will use is the CAPEX database from 1995 to 2018, which comes from the Center for Monitoring Indian Economy. This data set allows us to identify the exact location of each project, including the location, including the latitude, longitude of each project. So talking about our results, so what we do is we start with this data, and for each district, we compute the share of investment. Using the share of investment for each district, we compute the HHI for each state. So in the red line over here, I plot the average HHI for all states from 1996 till 2018. And in the blue line, I plot the weighted HHI weighted by the total investment. Now, over here, we see that these numbers are around like around 0.4 or 0.5, but we need to benchmark these numbers to basically say that these numbers are high. So we create 3 different benchmarks. In the first benchmark, which we call as number HHI shown in green, we assume what would have the concentration look like if there was equal investment across all districts. So it's basically like 1 by n. Then we have population HHI, where we create a measure of HHI, assuming the investment is proportional to the population. And lastly, we do the same thing for area. So when we compare our weighted and average HHI to these frictionless benchmark, we find that investment is geographically concentrated. More importantly, what we do is we start with a simple scatter plot of mean HHI with the percentage of district, with the percentage of direct rule districts in a state, and what we find is that there is an increasing relationship between investment concentration and the proportion of areas under direct rule. And we can see the same thing in a more econometric setup, where we regress the amount of investment project on a direct rule dummy, which is basically takes a value of 1 if the district J was under direct rule or not. We're going to have over here state year fixed effects and firm year fixed effects. So we are comparing direct and indirect rule within the same state. So we are trying to fix all the law. So what we find over here, that projects are smaller, the projects announced in direct ruled areas are smaller in size compared to projects announced in indirect ruled areas. We can do the same thing by actually aggregating the data at the district level and trying to create a balance panel. And this can basically tell us something about the extensive margin as well. And what we find over here is that the projects are 25% less likely to be announced in direct ruled areas relative to indirect ruled areas. We do a bunch of robustness tests trying to show that these results are not really driven by a lot of factors, including geography, covariates, and we also do a placebo test to show that these results aren't very spurious. However, we have still not ruled out the Krugman hypothesis and like differences in local opportunities hypothesis. So for this, what we do is we use a border discontinuity design. So instead of comparing all the direct rule districts with all the indirect rule districts, we focus on a small subsample of the area, which is bordering districts. One of them was under direct rule and the other one was under indirect rule. So what we'll do, so from now on, we'll focus on the sample of bordering districts within a state. And importantly, we will include these firm cross-district prayer, cross-year fixed effect. So what we're trying to compare is the investment project announced by the same firm within a district pair, but one district is in direct rule and one district is in indirect rule. So in this way, what we're trying to control for is local investment opportunity shocks, which are happening at that district pair level. And also we're trying to control for a lot of supply shocks, which are happening at the firm level. The key identifying assumption over here is that the adjacent districts would have followed similar paths had India not been colonized. More importantly, we can think of these firm district pair times year fixed effects controlling for costs of moving goods, people's ideas, so basically the Marshallian forces, the geography, and shocks to local investment opportunities. So using this border discontinuity approach, and I want to draw your attention to column number 3 over here, what we see is that the coefficient beta, which is the estimate associated with direct rule, is negative. And economically, it indicates that projects in direct rule districts are approximately 11% smaller in size related to projects announced in indirect rule areas. And please recall that this is all within a contiguous district pair. We can also do a doctrine of lapse kind of 2SLS analysis, and over there itself, we find very similar results. Now the question comes, how does this happen, or why does this difference exist? We argue that there are two primary channels through which this. So we argue that there are two primary channels through which direct British rule can affect or explain differences in corporate investment today. So in today's talk, I'll primarily focus on destruction of existing economic organization. Specifically, I will talk about cotton. So talking about the destruction of economic organization in the case of cotton, what we will show you that cotton producing districts were more likely to be under direct British rule. And these areas were subject to adverse economic policies, resulting in a destruction of existing economic organizations with long-run detrimental effects. So just a recap of the pre-colonial history of cotton in India. India was one of the largest manufacturing output producer in the world, accounting for approximately 25% of the global textile trade, and cotton was really an important part of this textile trade, which India was a dominant entity in. So just to show you a kind of a first page over here, you can see that if the area produced cotton during a pre-colonial period, that area was much more likely to be undertaken under the direct rule of the British. Specifically, a cotton producer district was 40% more likely to be under direct British rule related to an indirect rule. Now that leads to us to the next question: why were British so much fancied by these cotton producing areas? And the main reason was that the Indian cotton industry posed as the biggest threat to the British textile industry. So conquering or taking over direct control of cotton producing areas in India allowed Britishers to secure a monopoly on the supply of Indian goods and products, especially cotton. And this was done primarily to protect the interests of British textile industry. I think Karl Marx says it best when he says England began with driving Indian cottons from the European market. It then introduced a twist into Hindustan, and in the end, inundated the very mother country of cotton with cottons. So just to talk about some of the anecdotal evidence on how colonial destruction of cotton industry happened, I think there is this quote by Gandhi which really puts it very nicely. The labor of these artisans was so cruelly suppressed that they were obliged to cut off their own hands in order to avoid imprisonment. In my opinion, such cutting off would be less cruel than the terrorism which resulted in self-mutilation. So enough of talking, but I will also show you some econometric results with it. So over here, what we do is we look at what is the probability or what is the difference in project size conditional on pre-colonial cotton production in those areas. And we can do this analysis also in a two-stage least square framework, where we first regress what is the probability of an area being under direct rule as a function of pre-colonial cotton production, and then use that first stage estimate to predict what is the effect on project size. And what we find over here again is that that direct rule negatively affects the size of the project. And this is primarily driven through pre-colonial cotton production or acquisition of territories that produce cotton in pre-colonial India. So why the long run exists? So we hypothesize that there are two reasons why these long run effects exist. The first is the destruction of strong economic organizations hampers this intergenerational transfer of skills and knowledge. And more importantly, what it does, it basically disrupts the natural evolution or process of Marshallian forces and renders the comparative advantage of the area and its people futile, through which these long run effects originate. So with this, I would like to conclude. And the main message of the paper is that history explains approximately 13% of total geographic variation in investment. And taking our micro level estimate, the investment is 8 to 10% lower in areas. It's 8 to 10% lower in areas which were under direct rule. And the primary mechanism through which this happens is through destruction of economic organizations. Thank you.
Thanks, Nishant. So, Suzanne, is there anything else before I start the discussion, or I just take over?
You take over. And now Nishant is watching you for time.
Yeah, I was about to say that actually. So when Nishant gave me the paper, the first paper I received from you was 61 pages. And then Nishant updated the paper a few days back, and I was hoping that he will bring it down. So the new paper is 76 pages. So it was already a tough job to read the paper, and then to restrict Nishant in 15 minutes or 20 minutes to say that entire paper was very tough. Anyway, so let's see what, I'll just take it up from where Nishant left off. Let me share my screen. I hope it's visible. So I'll just summarize what the paper is all about. I think the baseline is basically a reduced form where present day investment varies across, they check whether present day investment varies across districts that were directly governed by the British vis-a-vis districts that were under princely states, so indirectly governed in other ways. And then they also look at the mechanism, and that is the main story of the paper. So colonial rule is detrimental to economic organization is one story, and the other one which he ended his presentation with. The other one is inefficient state as reflected in delayed road construction. And they also argue that this is not due to, the mechanism is specifically not due to agglomerative factors, which is availability and cost of resources, but more of historical circumstances. Right? We'll come to each of these in turn when I discuss, but just to, this is my understanding of the paper so far. So the empirical framework that they use, the baseline, is compare a firm's decision to invest in districts under the British rule vis-a-vis districts which are indirectly ruled. And they have a battery of robustness tests. Nishant had a slide on it. The few that I will mention are Oster test for omitted variable biases, district level covariates accounted for, placebo test using a random sample, randomizing the allocation of what is direct and which one is direct and which one is indirectly ruled, and several others. For identification, they particularly use three strategies, I would say, rather than two. The first one is comparing neighboring districts. Okay. The second one is using an IV, which is the doctrine of lapse. How did a particular district become a direct district from an indirectly ruled district? And the third IV that they use, which they also say is for mechanism, is basically the cotton cultivation. So whether a particular district was undertaken as a direct, was undertaken directly by the British, depended on cotton cultivation in that particular district. The findings are interesting. So percent of districts under, so this is something which I did not say, the very first one, which is basically concentration of industry within a state. The reason I did not say it is because I felt that 95% of the empirical work focuses on comparison of district of the districts, direct and indirect, and very small portion, although much of the motivation comes from this aspect that the historical circumstance determines investment concentration within a state, but the rest of the paper doesn't delve much into this except for one section. And the results over there is correlational. So I was a bit surprised, Nishant, when you on the slide when you said that these are facts. Because this is ultimately your estimation, right? This is not really a fact. This is a correlational. In fact, it's a correlational estimation as opposed to the rest of the paper, which is more driven towards causality. So percent of districts under direct British rule explains 13% of total variation in investment concentration in a state, which is quite a big amount compared to the agglomeration story that has been more popular so far, right? So the second most important finding in their paper is that investment is about 8 to 10% lower in direct rural districts compared to indirect rural districts, and the mechanism that they suggest is breaking down of economic organization, which is the inference that they draw from the cotton ivy, delayed road construction, which is basically a proxy for them for the state capacity or state efficiency. And they also rule out, they have a section where they rule out potential other mechanisms, which could be law enforcement, provision of public goods, trust, and so on. So I'll come to each of those again. So first of all, about the contribution. So I think given that it's a 76-page long paper, you have done a lot of things, but you need to really pin down what is the contribution of the paper more properly. So IR, which you of course mention everywhere, that IR 2010 is the nearest paper to yours. And what IR 2010 does, this is just for the audience over here, is they compare economic outcomes between direct rule and indirect rule districts, right, under the colonial rule. And what they specifically look at is availability of public goods, agricultural investments, and productivity. They do not find much difference in agricultural investment and productivity, which they say is converging over time between direct and indirect rural districts. But they do find that education, like literacy rates, schools, number of schools, roads, all are lower. The provision of all these public goods are lower in direct rural districts compared to indirect rural districts. So direct rural districts are in some sense worse off, much worse off than indirect rural districts. Now, this paper is about industrial investment as opposed to, and frankly, I did not find any literature there. You also do not cite, actually, I also did not see any literature which talks about institutions and industrial investment. Most of it is economic growth and at best agricultural productivity, right? So maybe you want to use that as one of your contributions, underlying mechanism, delay in road construction. What you need to do is you need to clearly position your contribution in the introduction, because what you have done currently is in the introduction, you have contrasted with the IR paper, which is, I don't find a major change from the IR paper. In fact, what I find is your paper is somewhat complementary to what she has already done. So it's some sort of an extension. You have talked about geographic concentration, but in your contributions, these things need to come out more clearly. The geographic concentration and the industrial investment, additional underlying mechanisms, and these need to be brought up more upfront in the introduction than being relegated to the literature review section. Coming to the methodology, how much time do I have? 10 minutes. So this is the equation, this is your main equation that you estimate. Okay. Identification. So basically what you do is you identify, see, your main variable over here is this district rule J, which is varying at the district level. That's it. Right. So which means that you cannot have district fixed effects and so on and so forth. So identification using variation in investment across districts made by the same firm in a specific year. So this is the best, what I thought your identification is coming from. Because if you say, I have taken state year fixed effects, then you're basically still comparing districts within the same state and year, and they might be different for all kinds of reasons, right? Cross-sectional variation, etc., etc. So the best bet over here is basically what you also mention in the paper is, because you have taken firm So this IY, so farm year fixed effect. So essentially what this means is that you are comparing whether the same firm is investing in district 1 as opposed to district 2 in a specific year, right? Depending on whether it's direct rule or indirect rule, which means what is the extent of the variation? You need to discuss that, right? What is the extent of the variation? How many firms operate across multiple districts in a given year? Because only if a firm operates across at least 2 districts do you get some variation. So you need to discuss, so you could show, for instance, the number of districts the average firm operates in each year in your sample. That's one. That's the main point I have over here in the methodology, with the main specification. The other point I have is you have used a section in robustness where you include a chain of a series of variables as covariates, which is absolutely the right thing to do. But my question is, why do you include lat long all of a sudden in your baseline and not in that section? Right? Because that's also a covariate at the district level. Why don't you keep them together? You just want to be very clear that lat long is not, I mean, your results still hold without lat long covariates, or if they don't hold, you need to think about why they don't hold. Okay, so the other thing is clustering. You have clustered. So see, again, your main variation is at the district level, current district boundaries, J. However, when you cluster at the old district boundaries, which is basically the colonial district boundaries. So there I got confused that if your variation today, variation that you're using to identify is coming from current district boundaries, I would think that the cluster should be at current district boundary level, not at the, and that to old district and year. So because you would expect that different firms invest, those error terms are correlated across firms or across firms within a district and so on. So basically what I mean is that you need to be able to control for the correlation or adjust for the correlation across firms within a district. Okay, so that's what I thought, that clustering at the district level, current district level, is more natural. For table 4, you have a lot of specifications in table 4. It's a bit confusing. So I would suggest that you specify at least the base equation in the paper, more so because in the first equation, you have a firm level data and you are able to include farm year fixed effects, which in the second specification, which is also your main specification for estimating the intensive margin, etc., all those effects. So it's important that you specify this aggregate equation, so it's clear to people where is the identification coming from, and you need to discuss the identifying assumptions as well, which you do not for the second table 4 equations. Okay, now coming to a few of the robustness that you have done. You have used Oster's 2019 test for to check omitted variable biases. Now, remember, Oster basically suggests a formal test for a setting where people traditionally have basically looked at various regression equations with multiple different variables, and the coefficient on the main variable of interest stays stable across all these specifications. There she says that you do not only look at the coefficients, you look at the coefficients in tandem with the R square, and she proposes a test which is combining the coefficient and R square, right? And this is under the assumption, and because it's stable, it's under the assumption that a proportional selection relationship exists between the observables and the unobservables. Now, the problem is, in your case specifically, you don't have stable coefficients across all the specifications, right? So I don't think Oster's test really convincingly says that there is no omitted variable in your context. In fact, if you look at your cotton IV, cotton cultivation IV, it says just the opposite. It says that districts that had more cotton cultivation are more likely to be direct districts, right? So which means there are already other reasons. So cotton cultivation is one of them, and possibly the what is it called, like the terrain or the type of soil, etc. These are all the things that are different between direct and indirect districts. Right? So there are likely to be lots of other omitted variables. So in many places in the paper, you do say that this is random, the district direct and indirect, but then you go on to say that it depends on cotton cultivation, etc. So you need to be a little bit careful over there. Robustness to additional geographic covariates is possibly the most important thing that you should do in your paper. You have done quite a bit. You have one table where you sequentially include a lot of geographic variables. I would suggest, in fact, you could go a step further over there, because that's really the most important part, since you have a cross-sectional variation across districts in your data. Try to add roads availability, distance to the nearest port. You have distance to the state capital, but nearest port, other public goods if possible. And one more question, possibly less important, but still I would say that you have two IVs. Why not use them in a single linear regression, right? I mean, single linear combination, and do an over ID test, because your first IV, the doctrine of lapse, is actually more likely to meet the exclusion restriction than the cotton cultivation IV. So I have a few comments on the interpretation. You have mechanisms. You test two mechanisms, as you said, the two main mechanisms: state capacity and or state inefficiency, and dismantling of economic organization. Now, of course, you have done a few things to rule out potential other causes like trust conflict, but there could be, trust conflict are just two variants of informal norms, right? There could be several other informal norms like cheating behavior, etc., right? Deception. So whether business deals are much more easily done in these districts. So what I would suggest is, because you have a well-established reduced form, especially using the doctrine of lapse, IV, etc., why not position your mechanism as potential rather than the only channels? Because, for instance, you have looked at enforcement using criminal cases, right? Filed, but the problem is that most of the business disputes actually first go to the district civil courts, and then they are taken up, depending on, so in some states, for instance, depending on the size of the case, the size of the amount of money involved, it can directly go to the high court or not, right? So, and delays in district courts could depend on whether a district was directly ruled or indirectly ruled, simply because directly ruled districts got their courts, respective district courts, much earlier than the indirect ruled districts, right? So they have many more pending cases and hence delay in cases. I'm just saying that these are possibilities which you cannot possibly rule out everything. So indirect districts maybe are less unequal, less urban, less costly land, all kinds of reasons. And in fact, IR has shown that it has better education and health outcomes. All these could also be driving investment today. Finally, the historical circumstances versus agglomeration. Again, I think that to rule out agglomeration completely is a bit difficult given your setting, because it could be that the better governance in the indirect districts is actually helping acquire raw materials, resources at a lower cost, right? So it could actually help with all the forces that lead to agglomeration. And this is completely new, additional. In addition to what you have already done. I don't want to be guilty of suggesting you to make it a 100-page long paper, but I think you anyway need to cut down a lot. Cut down not in terms of the content, but I think you need to shorten, send a lot of things to the footnote, so on and so forth in the paper. Which I'm sure you will do in the future drafts. But this is an idea which I thought from the beginning, and I relegated it to the last slide because anyway, it increases the size of your paper. So think about the type of industrial spread in India. So I don't know whether your data would allow you to say anything about that, but suppose that because you have the same farms operating in multiple districts, it's possible that the farm, so suppose direct rural districts are the ones which are more urbanized, which is most likely to be the case. then what they will see is that, so these are the regions which are also, I mean, in your map also, it's very obvious that these are the ones closer to the coastal areas, etc., the direct rural districts. They might have their logistical verticals in those districts and their manufacturing verticals in the indirect rural districts, which means that the investment requirement in the type of industry in the direct rural districts are very different than the investment requirement in the type of industry in the indirect rural districts. If it's possible to explore that mechanism, yeah, so that's just a suggestion. I end there. I have taken more time than supposed to.
Yeah.
And Nishant did not stop me. So
I
it
know.
was, as you have left it to us, I also did not stop Nishant. Nishant did not stop me. So it was a win-win.
Yeah.
Yeah,
For
I
you
think those
guys.
are the merits of collusion.
Yeah. Exactly. So, Nishant, Tanika, since we've run out of time for this entire session, may I request you, Nishant, to respond to Tanika's comments offline? And I will give 1 minute to the floor here. Does anyone have a comment to make? Shubho, please keep it short. You've got a minute.
Yeah. I would be interested to know if your results hold when we take firm ownership, because a lot of investments, especially from the 90s, were done by public sector undertakings, and a lot of them are just politically motivated. So India will build a refinery in the middle of Uttar Pradesh, very far away from any oil source or ports, and it will color the results.
Thanks, Shubho. By the way, both of you are in the same region for most part. I'm sure that you can chat about this over coffee. Is that okay? Right. So can we bring the coffee break up? Thank you, everyone, for having been really patient. And it's been a wonderful set of discussions so far. I'm looking forward, or maybe not, to the next one.